check it out, realtrade.io, and create a profile. It's free.
And it's the shortest route to the double dip.
Yep. Yeah.
And if you got stuff that's not on the MLS and you got a buyer, you can go on Realtrade. You can find a bunch of sellers that all know buyers, that all know sellers that aren't listed yet.
Yeah, the buyer lead.
Yep. So we're going to keep this thing at 30 or 40 minutes. If you turn on your camera and I can get some feedback from the audience, it works out well. If not, no worries. We'll have question and answer at the end, and Ryan and I will go over some time-saving tools for hardcore professionals. You can text me any future topics. It's really nice. After we do a show, I get a bunch of texts afterwards, and it gives us fuel for future shows and stuff I need to go into more depth and explain on. And all the stuff we talk about, I want to point out to you guys, it's super relevant. So a couple of weeks ago, we talked about fake sellers. And in the meantime, I have seen 3 fake seller deals. There's been articles in popular title periodicals. Say that 10 times fast, popular title periodicals. And fake sellers are real. So everything we're talking about here is relevant, timely, and current. Also, I want to mention that we had a couple of title advances that saved listing, that saved transactions. And then I saw a couple of transactions where people could have used title advance that would have absolutely saved transactions and had them close on time. So use titleadvance.io. All right, without further ado, welcome, Pablo. We're going to jump right into creative finance. So here is a screen share to the tool I created. Can you see it, Ryan?
Yep. Looks
All
great.
right. So here is creative finance broken down. You guys don't need to take any notes. I can't stress how important it is that realtors critically think about these deals, right? So right now is like we're in this weird time of super popular social media. And unfortunately, some of this stuff looks easier than it is. And it's not that it's complicated, but a lot of the details get glossed over. So the goal of today is we're going to be critical thinkers. You still got it on your screen, Ryan?
No, it's just like a screensaver that you have right there.
All right. New share. Is it up?
There it is. You got
All
it.
right.
It's back.
So the goal is to become critical thinkers. Don't take everything that you hear or see at face value, and be able to dissect these things and understand the exposures and the opportunities, but as importantly, the liabilities. I've recently received a ton more calls on creative finance, both from investors, realtors that want to do it. Ryan has a seller financing deal. So I'm going to break it down into 3 basic categories. Seller money mortgages, sub 2, and a wraparound mortgage and an assignment of mortgage. And if we understand the first concept, then the other 3 are a lot easier. So seller money mortgage, also called seller financing, purchase money mortgage, seller money mortgage, all the same thing. Several realtors have called recently about this, Ryan being one of them. It's another tool for the savvy agent when you're at the listing appointment. If you want to throw it on the table, it'll absolutely impress your seller that you understand what it is and you understand when it can come into play. Think of a seller money mortgage like any other mortgage. On the day of closing, the title transfers to the buyer signs a note mortgage, and the mortgage is recorded, and a lender gives the money to the buyer to give to the seller. In a seller money mortgage, however, do you want to say something, Ryan?
Yeah, no, it's true. And the seller just, gives the money to the buyer gives it back to the,
Yep.
Yeah.
In a seller money mortgage, however, instead of a commercial lender giving the money to the buyer, it's given to them by the seller. The seller gives the money to the buyer, and the seller simply walks out of the closing room with 2 things: less cash in their pocket and a note from the buyer. We'll go over the details in a second. I got a few calls recently, and the realtors were asking me about deeds of trust and contract for deeds and things like that. In Florida, if you try to do something clever, like a contract for deed or a lease with a purchase option in it and the lease payments look like mortgage payments. If the borrower stops making their payments and you sue for eviction, the borrower is going to defend with a constructive mortgage. So in Florida, I want you to remember one thing, form over function, right? It doesn't matter what you function over form. It doesn't matter what you call it. If it looks like a mortgage, smells like a mortgage, walks like a mortgage, they're going to have to foreclose it. So in Florida, judges liberally construe lease options and contract for deeds and all these things. Contract for deed is where I keep the property in my name. I give a contract for Ryan. Ryan gives me payments over time. When the contract is fulfilled, then the title transfers to Ryan. Unlike a seller money mortgage, where on the day of closing, the title transfers to Ryan. But all those things are going to be lumped into one category by a judge if there is a payment default and somebody evicts. It's all going to be lumped into what's called a constructive mortgage, and it's going to have to be foreclosed. So if you have clever sellers, and I get this call all the time, oh, we want to do something like a forfeiture clause or a something, and it's going to be, and we're going to disguise it, but it's really going to be a mortgage. It's going to be a mortgage, and any borrower can walk into an attorney's office and say, here's the facts of my case, and any decent real estate attorney is going to go, oh, that's a mortgage, and they have to foreclose. All right. So the seller walks out and they have less cash in their hand, but they have a note from the seller to pay cash over time. Why would a seller do this? They don't need the cash today. They receive more money than they would have in an outright sale. So one thing that sellers forget is the time value of money. And if you don't have an immediate need for the money, this can be a great way to increase your purchase price. And I've seen transactions sell at over list value when the seller put this option on the table. You can make a deal happen where the buyer can't qualify for any kind of a third-party loan. Seller financing only works if the seller has no current mortgage or a small mortgage. So a seller with a small or no mortgage has equity. If they have equity, they can leave in the deal and lend to the buyer. A cash flush seller without a lot of equity can even put money into the deal to make the loan to the buyer happen. So if you have a small mortgage and let's say the borrower wants to borrow more money and you have a small mortgage that you're paying off, you can actually, seller can actually put money into the deal to actually have a purchase money mortgage occur. The single biggest seller mortgage pitfall is, and I'm going to say this over and over, don't overlend. If I see one reason over my 40-year career of doing real estate transactions, 20 in private practice, it's that a lender comes to me and says, I want you to foreclose this loan. I had a couple in the last 2 weeks, 3 weeks, and they did not take enough equity position in the transaction. And so now the lender has to come out of pocket with some money to pay the lawyer for the foreclosure. So if you're lending 90% of value and values fall down a little bit, and at the closing, you only got 10% in the form of cash, you could easily blow through that in the foreclosure. The typical loan amount that people want to give is 70% loan to value. You'll see when prices are rising, people get aggressive and they'll do 80%. But I've been watching the hard money lenders right now, and they're lending 60 to 70% LTV. Somebody's got their mic
Yeah,
on.
it's, someone can mute their, trying to see who that is. I don't know if they're, there we go. We're good.
All right, thank you. So 70% loan to value gives you a nice cushion. V stands for value, which is not always the sale price. So we just saw a transaction recently where the borrower was wanting to borrow on a 615 contract, but the value of the property for all intents and purposes was more like 550. So 70% would be of the 550. Now I've also seen it go other ways where the borrower is buying the property very reasonably and very inexpensively, and then you can lend over 70%. I mean, then you can lend 70%, but that might be more than 70% of the contract value. So the point I'm trying to make here is that you want to stick with 70% of the value of the property, which is what the loan amount should be.
Mhm.
If you have a expensive property and they're buying it very reasonably, if the value is high and they're buying it reasonably, that won't typically be a seller money mortgage issue, but just for a hard money situation, if there's a third party lender, 70% LTV usually keeps you safe.
Jim,
Uh,
quick thing, there's some clarity here too on is Ryan Beckett mentioned it. Usually it's interest only, correct? That the seller financing does. Can you explain that?
Yeah, we're gonna
More
get,
deal.
yep, we're
Yeah.
gonna get more into that in a second.
All right, cool.
Good point, Ryan. Yep. If the property needs work, the value is the value today, not the value when the work has been done. So I hear this all the time. Again, this is also a hard money tip, not just a seller financing tip. You want to lend on the value of the property today. So if the property is in disrepair and it's the buyer borrower's intent to put money into the property and they feel the value is going to escalate very soon, as a lender, however, you want to assume that if you close on Monday, that the borrower may not make the improvements. And so if you have no control over if those improvements are to be made or not been made, and you overlend, now you're exposed as a lender. There's another thing you can do, which is actually even lend the money in draws. So you could, this wouldn't be a typical seller financing deal, but you could say, okay, on the day of closing, if it's a $400,000 loan, the borrower gets $300,000, another $50,000 when the roof is done, and another $50,000 when the pool is done. We just did a transaction where they borrowed $250,000 and we financed them 125,000 at the closing and another 125,000 when the pool was done. It was a big construction and they just needed some money to finish up. Again, not typical of a seller finance deal, but it's just ways to think about the loan. You don't ever want to be ahead of the value as a lender. The nice thing also is if you're lending in draws, then the lender can collect interest on the whole loan amount, even though the borrower doesn't have that loan amount in their hands. And we'll go over the terms right here. So typically 70% loan to value is typical, 8 to 10%, maybe even more in this current environment. 1 to 3 years is typical, interest only, no prepayment penalties, and some realtors structure amortized deals. They look good at closing, but they can become a real disaster for the unsophisticated lender when collecting payments or paying off. So we should really put 8 to 10% INTEREST only. Now, we have to be cognizant of Dodd-Frank. Keep Dodd-Frank in mind. So, Dodd-Frank is the body of law that governs. Can you see the addendum, Ryan?
Yep.
All right, so here is the addendum, is the FAR bar, and here is the box that you would check for the seller financing, C, and that would get you to this form right here, which is Dodd-Frank. Now, here are the two exceptions when the seller can make a loan happen. All right. These are the two exceptions. We can do a whole session on Dodd-Frank, but 90% of your loans are going to conform to Dodd-Frank when you have a seller that's giving financing either to a house they own that they lived in or a house that they own that they rented. Here's the big exclusion in Dodd-Frank that you have to keep in mind. That the seller did not construct or act as the contractor for construction of the residence. That applies in both exceptions. Now, the one exception to the exception would be is if your buyer is buying the property to rent the property and it's income producing property. So there's a thing called the 1 to 4 family commercial exemption that would get you there. I don't want to confuse you guys. If you have this transaction and it's coming up, text me 24/7. I'll walk you through it.
Yeah.
But the thing to take away is this. If your seller is giving a loan, and this is what I see more frequently, I think Pablo and I have one to, well, no, it wasn't Pablo. There's another agent that I was working with. If your seller did general contractor work on the property, either as an owner builder or they hired a contractor, you cannot give seller financing. All right. So
Interesting.
so that's something you have to bear in mind. You can't buy property, fix up property, and give seller financing if the borrower is going to reside in the property. If the borrower is not going to reside in the property and it's an income property, there's another exemption you can fall under to give that loan. All right, back to the outline. So keep in mind Dodd-Frank. Anybody have any questions so far? No.
We're just going to talk about, I just wanted to talk about the, like I said, the interest only payments of how those are structured. So,
Yep.
yeah.
Structuring a deal. Did I go into interest only? All right, so let's do it right now. So interest only is going to be a easier way for your lender seller to maintain the loan, to maintain accounting for the loan payments. And so you're going to calculate simple interest. So if you're going to lend $100,000, you're going to collect $10,000. Let's say it's 10%. You're going to collect $10,000 a year, and they're going to make payments to you of $833 a month. Easy. And so if it's a 3-year interest only loan, that's an easy way to calculate that.
Yeah. So
And
you just
then,
do, I mean, you just do the loan amount, you do the loan amount. Let's say it's, you know, because like, let's just bring up the one that I'm working with right now, which would be like a
Mhm.
1 point, let's just call it, just for sake of saying, a $1 million loan, right? And
Mhm.
the seller is looking at financing it at 6% on a 5-year, you know, balloon, right? So 1 million times 0.06 should be 60,000 a year divided by 12. So the buyer would pay $5,000 a month, right,
Mhm.
to the seller. And then for the next, you know, however many years, there's no prepayment penalty on the loan, as we discussed with you, Jim. And then they can pay it off any time, but there's no principal reduction at all, you know, so just they're paying $5,000 a month. And then at the end of 5 years, they owe $1 million, right?
Yep. So the nice thing about interest only is you're going to get the entire lump of principal back at the end, and it's easy to calculate. Yep. I don't recommend that sellers get into collecting for taxes and insurance. Have the borrower maintain their own taxes and insurance and send proof to the seller, that seller lender, that the taxes and insurance are satisfied. And we'll go more into the insurance in a minute. But that's better from an organizational, from an administrative standpoint than collecting it and then maintaining it in a separate account and doing all the things you would have to do if you were receiving those payments. Always keep Dodd-Frank in mind. The easy way to find Dodd-Frank is to go to this form, and then you can come up with the Dodd-Frank test.
Jim, Lindy had a really great question. If you look in the notes, she asked, how is this treated by seller from a tax standpoint?
Oh, good question. We're going to come up on that in a minute too. All right, proof of insurance, naming the seller as a mortgagee. So always get 2 things from your borrower in every deal. Proof of insurance, naming the seller as the mortgagee. There's a mortgagee clause, and a survey of the property, name the lender as a certified party. I can't tell you how many people I see do deals, don't get surveys on their loans, and have problems down the road foreclosing, and there's a survey issue. Tips on structuring a deal. Use the seller money financing addendum in the FAR forms. Pay close attention to Dodd-Frank rules. They are spelled out at the top of the form. 90% of all your deals are going to conform to Dodd-Frank, 95%. Use titleadvance.io to determine if there's a mortgage on the property before you go to your listing appointment. If there is no mortgage, seller can leave money in the deal as a loan and make more money in the end. Now you have another tool to differentiate you as the superior agent. Choose a competent title agent to close the sale. The deal will go more smoothly if all is done in-house. The title agent may supply the note and mortgage forms, but that doesn't mean they are qualified to complete them. Note, a title agent can provide a form, but it is the unauthorized practice of law for them to give advice on the loan, on the note. This is not a self-serving lawyer plug, but if you use a lawyer to draft the note and mortgage, no party will be able to come back on you, the agent. Remember that the buyer borrower always pays the loan fees. So if the drafting of the note and mortgage, that's always going to be on the buyer's side, doc stamps and intangible taxes, recording fees, the cost of a survey, and if the lender has an attorney to review title in the survey, that's always going to be a buyer borrower expense. My experience is probably not a good idea to tell the seller to include taxes and insurance in the mortgage payment. Again, unless they're a sophisticated lender, this can be a nightmare and make the borrower pay these directly to the tax collector and get proof of insurance and proof of taxes in writing. Here's the tax advantages section. Realtor exposures and potential liabilities. The single biggest mistake I see it over and over is a seller giving a loan amount that's too big. We talked about that previously. If the loan amount is too big and the buyer stops paying and the seller lender has to foreclose, this can result. The seller could be paying money in excess of what they received at the closing to pay for the foreclosure. For example, I saw a deal a few months ago. Seller received $10K at the closing. They spent $15,000 on the foreclosure. The buyer may have trashed the property now and the seller is the high bidder and gets a trashed property back. So in the worst case scenario, I saw a commercial transaction recently. They had already inked the deal. It's for a 760 sale. The lender gave $740,000 and it would be not a big leap for the buyer borrower to destroy, to degrade the property. And now and they were really good terms. There was a high interest rate and it was commercial property. So there was no Dodd-Frank, but it would be not a far stretch of the imagination to imagine they ran the property into the ground and now they're foreclosing their 740 loan and they're the high bidder and they're getting the property back, right? Because if the let's just say the judgment amount in the foreclosure, let's say after all is said and done, with attorney's fees and default interest and everything they missed, let's just say the judgment comes out to 770, $30,000 in fees and taxes and insurance and interest. So if the bidding ends south of the judgment amount, let's say the bidding ends at 769, now the borrower is going to get the property back. But if the bidding ends north of 770, then the borrower is going to be made whole. But if the property's been degraded and maybe they sold on an inflated price, and the bidding ends at 600, now the borrower is getting the property back and it's.
Hey, Jim, we have a quick question here from Ryan Beckett.
Yep.
Assume the commission from the agents are paid out of the 30% down, correct?
Yep.
Yep.
So if they're going to lend, the commissions are always going to be paid out of the cash to close, and it's going to be a little bit money taken out of the seller's cash to close. But if you were lending on a deal like we're going to go into in a minute and subject to, it's possible that one party is coming out of pocket to pay the realtors directly and it's not being paid out of the cash to close. Have the same firm drafting the note mortgage as the closing sale and have a lawyer draft the note mortgage and advise the parties of the loan terms. If you have the lawyer advise the party to the loan terms, you're never going to run into problems. Tax advantages. An often overlooked benefit, myself included, of a seller money mortgage is the tax benefit. In a dramatically oversimplified example, 15 years ago, seller bought a property for $300,000 and then sold it this year for $1 million, resulting in a $700,000 capital gain. Unless some other form of tax income protection is used, the gain is fully taxed this year. With a seller mortgage, the tax on the gain is paid over time with the loan payments. So if you have an older seller and they don't have an immediate, or any seller that doesn't have an immediate need for the money, and they want to make some money and not pay capital gains immediately, then a seller money mortgage is a great tool to use. And then the seller is only taxed on the portion of the interest payment, on the portion of the loan payment that's attributable to the capital gain. So if it's a 30-year mortgage, then your capital gain is going to be spread over the life of the loan. If it's a 3-year mortgage, then the capital gain is going to be stiffer and more upfront. So that'll give you. Go ahead,
Quick question. If it's an interest only loan, like the one I was discussing for the seller that I'm working with, so they would just pay I guess the gain, because it's all due in 5 years, right? Because it's an interest only balloon, so they'd pay the gain in 5 years.
Well, they
Correct?
pay a little bit of the gain.
Little bit,
over-
yeah.
And then yeah, exactly.
Okay, and then what about this? Because he was asking about this, about being able to sell the loan, right? Is that a possibility? If, I mean, with the structure that you're able to do, Jim, creating this seller financing, is it possible to sell the loan to another investor?
Yep. So there are third parties on the in the loan space that buy these loans.
Mhm.
And we've been exploring that lately at this office. And I thought that they would be a much more rigid in the terms, but it appears there are buyers for loans of varying terms. So you can be a little more creative and you can be a little more flexible in what you offer. So you want to sell the loan. If you sell a loan, you want to sell it at par plus. So if it's a interest only $100,000 loan, you don't want to sell it for $90,000. You want to sell it for at least 100,000 plus something.
Mhm. Hey, Lindy had a quick question. So you can please clarify Ryan's example. Is that so the tax due 1/5 every year or all at the end of the 5 years? Do they pay the tax on the interest they earned because it's interest only? And then the one lump sum at the end of the 5 year when the balloon comes? How does that work, Jim?
We're talking about two different taxes. So when we were talking, I think they were talking about income tax on the interest. So there will be an
Okay.
income event because the seller is going to receive some interest income. That's taxable. But there's
Okay.
also the capital gains event, which is what I was talking about. When you do a seller money mortgage, you don't pay the capital gain at the time that you sell the property. So think about it like this. When you sell a piece of property, the buyer comes to the table with a loan from Chase. Regardless of where the buyer got the money, the seller pays the capital gains all in the year that the sale occurred. If you sell your property with a seller money mortgage, like you were explaining before, 5 years, interest only, 5-year balloon, then there's going to be a small capital gain paid at the time of the sale. And every year until the 5-year balloon, you're going to pay small increments of capital gain tax. And then when the loan balloons or is paid off, then you would owe the balance of the capital gain. So if you had a 30-year mortgage with no balloon and everybody held it to term, then the seller is never going to have a blunt capital gain event.
Yeah. So let me ask you this question. If he sold the note, how is that viewed then? Because he's not actually, what if he sells the note? Is that a capital gain then? I mean, how does that work?
If you sold the note, then you'd receive a lump of cash. And I haven't researched it, but I'm more than certain that you would have the capital gain event at the time you sold the note.
Okay.
And since it's a note, you wouldn't qualify for 1031 treatment or something like that.
Got it.
So the goal is if the seller doesn't need the money right away, the goal would be to defer the capital gain into smaller increments with the seller money mortgage.
Yeah.
And I forget about
that's the situation with the seller that I'm working with. He's 70, he's like 70 years old.
yeah.
Yeah.
And so now they get a nice little annuity.
Yeah.
Parting seller money mortgage thoughts. There is a lot here. The seller money mortgage is complicated. It's not as complicated as it appears. Seller money mortgages can be a great tool to unstuck a frozen financing deal. They can also be a great bridge loan. So if you have a transaction, and this is a really important one, I wish I mentioned this earlier. If you have a transaction that's falling apart and the seller doesn't have an immediate need for the money, you could give the seller money mortgage until the buyer could find more permanent financing. And I forget about this tool as well. And so if that's an option for a seller and you want to keep the deal and get it to close on time, a bridge loan from a seller money mortgage can be a great tool to get you there. Remind your seller to check that the taxes are paid. A tax lien is one of the only tools that can wipe out a mortgage. So a mortgage is a beautiful thing. As long as you record it in first position and your title company gives you a title insurance policy, gives your seller a mortgagee policy, then there's not much that's going to wipe out your mortgage. However, the buyer borrower's failure to pay taxes would result in a tax lien foreclosure that would wipe out the mortgage. That's why you'll see, I don't know if you guys remember back in the mortgage foreclosure crisis, lenders would pay borrowers' taxes. And I always had borrowers calling me up and saying, oh my God, my lender paid my taxes. I haven't paid my mortgage in 3 years, but my lender paid my taxes. That's because of the seminal rule that the only thing that can take out the mortgage, for the most part, there are some other liens that could take it out, but the 99% of the time, the only thing that can take out a mortgage is going to be the tax lien foreclosure. Make sure the insurance is kept current. I can give you some great examples of where that didn't happen, and we had seller lenders that got really disappointed. Should the seller sign a personal guarantee? The best answer is maybe. The most practical answer is no, and always make sure there is plenty of equity, 70% LTV. So the personal guarantee, as a seller lender, you want to give your borrower the fewest options to defend that you can. And so if you just lend on the equity and you keep it square on 70%, that's going to be your easiest avenue to get the property back and make yourself whole if the borrower stops paying. Tell your client about the seller financing option, tell them about the industry standards. Don't give them definitive terms, and refer them to an attorney, and text me 24/7 if I can ever help with any of these things. You don't want to be in the position where you're saying, here's what you should do for your loan, and here's how you should structure it.
Yeah.
You want to tell them what the space looks like.
I just want to add one last thing to what Jim said about seller financing. In our office, we see a lot where sellers don't require insurance. And like Jim said, there's so much examples why you always want to convince your seller to force the buyer to carry insurance while they carry that loan, because you're exposed for the full loan amount without that insurance.
So as a seller lender, if the property isn't insured, we just closed the loan down in Boca. It's $1 million property, and the loan was for $100,000, so they could finish out some details on the property. Nobody cares about insurance, right? If it's $1 million property and there's a loss, the dirt's going to be worth 100 grand. But what if there's a loss? What if there's an injury on the property? What if there's any million number of things? 99% of the time, you're going to be best covered if you have insurance on the property, and the insurance names the lender as the mortgagee. You got to have it. It's a additional detail, and you got to make sure they maintain it. And if they don't maintain it, if the borrower stops making the payments, and you do have the mortgagee clause in there, then the lender is going to get notice of a stopped payment. So you're never, what they call naked.
Mhm.
Selling subject to. So that's the first category of creative finance. Now we're going to talk about subject to. If you understood the seller money mortgage, now subject to isn't that big a stretch. At the closing, the title transfers and the seller is paid typically very little. Sometimes the seller even pays to close, but the reality is these deals are typically done when there's not much equity. And so the money that changes hands is usually little or nothing. And here's the sub two twist. The seller's mortgage is not paid off at the closing. So the buyer takes title subject to the seller's loan. If everybody's not getting a little uncomfortable right now, then you should.
I mean, you see these videos on YouTube though, guys, like, I've actually had clients reach out to me. Hey, Ryan, we want to do a subject to deal here. Like, this is the new thing in real estate. And you listen to these guys, and then, obviously I've dug deeper with Jim on this, but it's relevant information. I think it's going to be even more relevant as there's more, people out there on YouTube, especially sharing this info.
And so if you're not uncomfortable, like I said, you should be uncomfortable. And here's why. Now the buyer then makes monthly payments to the seller's lender directly, hopefully. I'll explain more. So you got a closing, everybody shows up to close, and everything happens just like in a conventional transaction. And the buyer gives the seller a small amount of money. And the only thing that's different is the seller's loan is not paid off. But wait, it's still in the name of the seller, correct? Yeah, absolutely. So what are the problems that can occur around that? And so, or no, when the buyer sellers would want to consider doing a sub two sale? it can make a deal happen when the seller is motivated, when the buyer can't qualify for a loan, or the deal is really skinny in the equity and there's no money to pay for closing costs. It can be a quicker relief for a desperate seller. But giant caution, whenever one of the parties is desperate, your spidey senses should be tingling. Proceed cautiously, make sure everybody understands the risks. There can be no money down or little money down, instant equity for the buyer. So that's a pro. And it can make a deal happen where everybody else was stuck on third-party financing. It can also cut down on the buyer's loan costs, right? The buyer doesn't have to qualify. They don't have to pay loan costs. They're easy deals to make happen on paper. Since these deals tend to have less equity and buyers don't have much at stake, some deals close without even title companies. So the deal may close really quick and very inexpensively. Again, caution, whenever a deal closes cheaper and quicker, your spidey senses should be tingling. Seller downsides of a subject to sale. All right, pause. Seller financing, 70% rule. Subject to sale, here's why you should be uncomfortable. Sellers should never give up title to a property if your name is on the loan and the property is security for that loan.
Wow.
Does everybody understand why that is? It seems like it shouldn't be that big a thing, but this is a huge issue, right? So if you don't have any money and you can't pay your mortgage and you're living in the house that the mortgage is on, what's the worst case scenario? You're going to give the property back to the bank, right? And you're going to knock down that mortgage. But if you don't control title to that property, how do you give it back to the bank? So if you transfer title to a buyer, you have given up the ability to sell or give the property back to the bank to pay off the loan. So if the loan should go into default, which loan is now being paid by a third party, you have no ability to reduce the loan amount balance by selling the property or giving it back to the bank, also called a deed in lieu of foreclosure. And I give you an example below. The due on sale clause.
Yeah.
These are big reasons why you seller downsides of a subject to sale. So you have the due on sale clause. This is the clause in almost all mortgages that says if a borrower transfers title to the property, the seller agrees to pay off the mortgage. The seller lender, the seller agrees to pay it. Yeah, the seller. It's difficult, if not impossible, to obtain a hazard policy. So the due on sale clause is in 90% of all, 95% of all commercial mortgages from Chase or Bank of America or Wachovia or whoever. And those clauses say that if the property is ever transferred or any element of the property is ever transferred, then that mortgage gets paid off. And you'll see people all the time drafting quitclaim deeds and things like that. Those quitclaim deeds, even if they just add their sister to title, those quitclaim deeds run afoul of the due on sale clause. So technically, that mortgage is supposed to be paid off. Practically speaking, does the lender call the loan if they added their sister to title? Practically speaking, very, very, very rarely. But if you have a transfer of title and now a whole new party is residing in the property and they're not maintaining the loan, are they going to call it? Absolutely. And if payments are being made, are they checking on the property to see if it's being maintained? Maybe, maybe not. I mean, I've heard stories on all sides of the fence about that stuff happening, but the reality is if the payments are being made, they usually don't check on the property. Another difficult situation is, from a seller's perspective, is the hazard insurance policy that insures the lender's position, leaving the seller exposed in the event of loss. So if a buyer gets insurance and there is a loss, the buyer could get paid the claim and not pay the loan and take off, leaving the seller liable on the full loan amount. So in 90% of all loan policies, if there is a loss on the property, the first person to get paid, the first entity to get paid, oh my God, Ben, that kid is so cute. You got to do that more often. The first entity to get paid is going to be the lender, right? And so the seller can't skate away with the money without paying the lender. In a subject to sale, it would be possible to, so the problem with the mortgagee clause is the mortgage names the seller And so the policy is being applied for by the buyer, who's not the borrower. And so if they get insurance and there's a payment, it's possible that that payment goes into the buyer borrower's pocket and they never make a payment. Now they have a loss and the seller could be stuck with a real mess.
I mean, when would there be just, you know, and we got a couple questions I want to get through or two, Jim, that people have asked. I mean, when would it make sense for a seller to do the subject to? I mean, when would it would be like, you know, some drastic situation where, you know, they have no equity in the house, right? I mean, they might be moving for a job or something crazy like that. It would be like the only way I could even see this making any kind of sense.
So a subject to can make sense if the borrower doesn't have personal liability. I think that's the last sentence in this
Oh,
sentence.
really? Okay.
Due on sale clause, performance fee, realtor's exposure. All right, I'm gonna unpack this as quick as I can.
Yeah.
Buyer's pros, subject to, we talked about that. Oh, no. Buyer's pros and cons of a subject to sale. So why would a buyer do it? The buyer has no personal liability. There's nothing that the buyer can do that can be boomeranged and they can be tagged by the lender for anything. So that's why a buyer would do this. They have no personal liability. The cons, the due on sale clause. So if the bank calls the loan, now the borrower has to go out and find some money to pay off the loan. And if the bank forecloses, even if the borrower has been paying the mortgage down for a long period of time, if the bank ever forecloses, the buyer could never go after the surplus.
Wow.
So if the loan amount is $300,000 on the day of foreclosure, and there's a surplus, that surplus goes to the seller who is in title, not to the borrower who assumed the title. Here's an actual client example. Homeowner closed on a $500,000 home, got a $450,000 mortgage. A few years later, the homeowner got an out-of-state job and they closed the sale subject to because it lingered on the market forever, and the title transferred to the buyer for no money to the seller. The buyer paid for the seller's realtor a few $1,000s. There was a title was subject to the existing mortgage. The seller's mortgage was not satisfied in the sale. The seller's mortgage had a $445,000 value at the time of the sale. The buyer had the seller sign some forms provided by the buyer's investor mentor, their investor coach, and the buyer was to make the future payments to the seller's mortgage company. What happened after closing? The buyer rented the property. It was beautiful, $3,500 a month for 3 years. They pocketed 125 grand. The buyer made a few mortgage payments and then said to themselves, whoa, wait a minute. I'm making a whole lot of money here. Why am I making these mortgage payments? And stopped. The property became very degraded. The rents fell, and eventually the buyer stopped renting the property. And at the time the homeowner came to us, it was the 3 years later, the property was now worth $300,000. The mortgage amount was now well over $500,000. So now what does the buyer do? Title, what does the seller do? Title is vested in this buyer still. The seller owes the bank 500 grand now. They don't even have control of the property to give it back to the bank. There are options: get title back, give a deed in lieu of foreclosure, and mitigate the loan balance due to the lender. For the borrowers, this would have to, now that the seller would have to sue the buyer to do that. It could take 6 months. The cost could be $7,500, depending on if they fight or not, or file a bankruptcy to avoid the personal obligation. Now this guy has a great job, the family has a great job, they're living a new life, they got to file a bankruptcy and take a deficiency judgment. Or a problem here was the homeowner was not eligible for a bankruptcy, now making the decent money, and it was easy for them to get a deficiency judgment. So a deficiency judgment is if they foreclose and if the bank forecloses, and at the foreclosure sale, the debt amount is $500,000, but in the sale, it only yields $300,000 at the foreclosure sale. Now the lender can go after the borrower for $200,000 in deficiency. Let me know if that doesn't make sense. I saw tons of transactions like this. The original homeowner with a debt amount, had no property, and now the lender, the loan amount went way up and they had to foreclose, and there was deficiency judgments levied against good, solid sellers, good, solid borrowers. I saw others where the due on sale clause, so they did subject to financing, where the due on sale clause was triggered and the buyer could not refinance out of the property. Now the seller is stuck. They don't control the property. It's going to foreclosure. The borrower buyer can't refinance out of the property because for other credit reasons, and it's just a train wreck in slow motion. From what I can determine, there are two tools discussed in social media that are available to sellers to make them comfortable with subject to sales. There's a due on sale clause insurance policy and what they call a performance deed. The due on sale clause insurance policy is an insurance policy paid at the time of the purchase subject to. So at the time of the subject to purchase, either the seller or the buyer pay this insurance policy. Then during the life of the loan, if the due on sale clause is triggered, it only happens if the due on sale clause is triggered, then the insurance company gives the buyer a loan with the same terms as the seller's mortgage, and the seller's mortgage is paid off. So the due on sale clause is triggered. If you have this insurance policy in place, now the insurance policy pays off the seller's lender and the buyer continues making payments to the new lender. Does that make sense?
I can imagine that there's insurance companies out there that you have faith in that'll stick around for 30 years. I mean, that would be pretty incredible.
Did the mechanics make sense, Ryan, the way I explained it?
I mean, it makes sense. I mean, but
All right.
like I said,
But
I
now
would leave
now the business reality is seller's protection is only as good as the liquidity of the insurer.
yeah.
I can find no due on sale clause insurers with a high rating. They may exist. I just haven't been able to find them. And I would be reluctant to rely on a one-time payment to a company and expect them to be there in, could be up to 30 years to stand behind this mortgage. And then the other problem is if they require ongoing payments, who's going to make the ongoing payments? Is that a seller thing or is that a buyer thing? It's just kind of a mess. The other way that these things kind of can fly, the social media proponents would tell you, is a performance deed. Although I've never seen one, I've heard them explained in several podcasts and we've litigated similar cases. The theory is there's a deed and the deed has a self-actuating trigger. So if the buyer borrower stops making their loan payments, title automatically reverts back to the seller. I'd love to see this in operation and execute harmoniously, but I could write an encyclopedia on the many reasons why this would not occur. There's so many reasons. And if anybody came into my office and they said, I would never represent this person, but if anybody ever came into my office and they said, hey, I did a subject to sale and there's a performance deed and I'm the borrower, right? I did a subject to purchase and I'm the borrower on the side of that transaction and I haven't been making my payments and I want to interrupt this performance deed that automatically puts the title back in the seller. For 1 month's rent, I could keep that buyer in title a long time, really frustrating the seller. So for cheap money, I could spoil any performance deed. In summary, it sounds great, but it's way more complex. Realtors exposure and potential liability.
This is the big one.
Realtors exposure and potential liabilities. A realtor's best bet to avoid liability to a buyer or seller in a subject to sales, refer your client to a competent real estate attorney for an opinion. Some attorneys like to justify their existence by making things more complicated than they have to. Some are practicing out of their zone and they oversimplify things. A good attorney can break down a deal and explain it to anyone and get all to understand the opportunities and exposures and let the parties make the decision. Right? So you're not making the decision. It's an educated decision by the parties.
Also, too, Jim, we want to add, like, these obviously subject to deals. Like I said, I've come across a couple of them. They're really skinny, right? So, typically what would happen, the seller, right, can't pay a commission, right? Because there's no, the deal's so small. So typically, if there is a commission, the buyer will pay.
Yeah. Typically, the buyer pays a reduced commission to an agent.
Yeah. So you're just wasting a lot of time.
It's an off-market deal, and the buyers are pretty savvy, and here's the thing that you said, Brian, that really triggers the concern. The buyer doesn't have much skin in the game, right? The seller's got a whole lot of skin in the game. The buyer is just along for this like income and equity ride. If things all turn out, I'm happy. But if things don't work my way, I'm not making my mortgage payments. And I have seen seller money mortgages, and we do have a solution for the seller money mortgage, which we'll go over in a second, that can make it work. But if a lender, so here's the biggie right here. When would a seller ever give a subject to mortgage if the lender has no personal recourse to this seller? So that's called an in rem transaction. And no matter how degraded the property gets, no matter how bad the borrower is, no matter how many payments are never made to the lender can never go back after the seller. Not very frequent in residential transactions.
Yeah. When would that
Occasionally-
happen, Jim? I mean, can you give a quick, how does that even work? I mean, there's, who signed the original note?
I haven't seen a residential transaction in my practice. I haven't seen a residential transaction that didn't have personal recourse to the seller, to the borrower.
Yeah,
I have
the
seen
borrower.
many transactions to the borrower. I've seen many transactions in commercial where they've negotiated away the personal recourse. But if you're a seller and you're selling residential property subject to, 99.9% of the time, you're going to have ongoing personal liability on your loan. If you're selling commercial property subject to, read the note carefully, there's a chance that you don't have a personal obligation.
Right.
But in the vast majority of commercial transactions, you still have personal liability. All right, now comes the wraparound mortgage, also called the wrap. Here is the only reason that I could justify giving a subject to. It's called a wrap. So if you understood subject to as wrap is an easy next step. A wrap is a subject to sale where the buyer pays the mortgage amount to the seller, however, and the seller pays the seller's mortgage lender directly. And the seller holds a second mortgage on the property. This is the key right there. And the seller holds the second mortgage on a property. So on the day of closing, I sell property to Ryan, subject to, Ryan pays the realtor. There's no money transacting in the deal. Nobody gives anybody any money. Ryan pays the realtor $5,000 or whatever the number was that makes the realtor happy. Now Ryan is the title holder. Oh my God, I've transferred property away and I still, chances are, have personal recourse. Why is that acceptable or approaching acceptable? Because I have a wrap. So what we did was on the day of closing, Ryan took over the property. He's the title holder now. And on the day of closing, me, the seller, recorded a second mortgage so that if Ryan doesn't pay me on the second mortgage, then I can foreclose.
Yeah.
Somebody's got to nod their head. Everybody follow me?
Yeah.
All
It
right.
makes sense.
So now I sell Ryan my property. Ryan is making the mortgage payments to me and I'm paying the first mortgage. So now as a seller, I feel safe that the mortgage payments are being made. I have control and I have an easy tool. Remember I told you I could spoil that performance deed if I wanted to relatively easily. It's a lot harder to spoil a mortgage. There are some tools, but performance deed is an easy one to spoil. Spoiling a mortgage foreclosure is not as easy. Now the seller has a direct and proven line of recourse against the property if the buyer does not pay. The seller is known as now as, and the seller is in the know as soon as the buyer stops paying. The seller can collect more from the buyer than the value of the mortgage payment and keep the difference each month. So let's just imagine my first mortgage payment was $1,500. And from Ryan, I collect $1,700. So every month I pocket $200. These deals are approaching the make sense realm. Make sure makes ensuring the lender's position easier because now the seller is a named mortgagee, right? So now I have a mortgage And now Ryan could actually go out and get an insurance policy and name me as a named mortgagee. What are the problems? If the seller stops paying the mortgage, buyer has to continually check up on the mortgage status, and if in default, reinstate and make payments directly. So in the first transaction, when subject to, the seller was having to constantly check and make sure that the buyer was making the mortgage payments. In these transactions, the buyer is going to want to check up and make sure that the seller is making the mortgage payments. And it's going to be a difficult thing, can be tough to do because the buyer is not an authorized party on the loan, right? So if the buyer is not an authorized party, then how do they get loan status? Seller still has to sue for a remedy, but the buyer has fewer defenses. A wrap violates the due on sale clause, which can still hurt the buyer's position. So if 10 years down the road, they get a due on sale clause call, the buyer still has that problem. Not so much the seller's problem anymore because they can foreclose their mortgage now, but it is a buyer's problem. Subject to makes sense. A wrap if a subject to makes sense, a wrap provides security to the seller, and in many cases, I would recommend these to my clients, even if I have personal liability on the loan. It's if the subject to makes sense, the wrap is the thing you want to do to make the subject to legit on all sides. And you'll never end up, so as a realtor, we'll never have problems from a seller perspective or a buyer perspective, because everybody has a dog in the fight and everybody has easy recourse, and you're not relying on these exotic things like a performance deed or due on sale clause insurance, which they aren't proven tools. All right, last but not least, what is an assignment of mortgage? An assignment of mortgage is basically an antiquated tool. The basic mechanics are the title closes, the title transfers to the buyer, and the seller's loan stays in place. Like a sub or a wrap, the seller's mortgage stays in place, is not paid off, and survives closing. Unlike a subject to or a wrap, the note and mortgage are now in the buyer's name and the lender has zero recourse against the seller. Does that make sense? So in an assignment, it's just like any other loan, except that now you're not gonna, well, you'd still probably have to qualify, but now you're not. It's just like any of the other exotic loans we talked about, but now the loan goes directly into the buyer's name. Buyer gets the benefit of all the equity payments, the loan payments the seller made over the life of the loan, and they get the increase in equity, and the seller has zero liability or exposure after the sale. The big problem with assignments is almost no residential lenders let them occur anymore. And in many commercial deals, realtors may say they are possible, but a few commercial lenders will facilitate them. So I see this frequently. Realtors say, oh, you can assign a loan. You got to make sure that the loan is assignable, particularly in commercial deals, never in residential. I've never seen a residential assignment in 20 years. In a commercial deal, read the note. If it's assignable, it'll say so in the note. Contact the lender. It'll say, the lender will tell you if it's assignable or not. But in a residential deal, I just had one the other day where the realtor was insisting that the note was assignable. It's not assignable. So double check that stuff. All right, we're 57 minutes into it. If anybody has any questions, now
We have a few questions here that we wanted to go over here. John asked, in regards to the subject to, I've heard a term called servicing company. I'm not sure, but I think they are a company that makes sure that payments are made or recorded. Does that make sense, Jim? It's just like a third party.
Yep. So you have a loan servicing company, and in a subject to sale, you could use the loan servicing company to make the payments, and then the seller could check up on the loan servicing company to make sure that the loans are paid. The downside of a loan servicing company is the borrower is never going to throw that out because it's an additional cost to the borrower. So if the seller says, I'll do the deal subject to, but you have to use a loan servicing company, who's going to pay for the loan servicing company after the sale? It's going to be the borrower. And are they going to be thrilled about that? And are they going to continue making the ongoing payments to the loan servicing company? It's kind of the same thing. You're relying on this hope that the borrower is going to keep making the payments. And they're also going to keep making the payments to the loan servicing company. So yeah, it's a possibility, but again, it doesn't really mitigate your risk. from a business perspective. It legally mitigates your risk because you have a way to go and check up on the mortgage payments and you're hoping that it happens. But you still have that same business burden on the borrower to keep making those payments. And now they have another payment. What else do we have here? Lien theory state, Ryan Beckett.
Oh, I think we
Yep.
went through it. We got through those.
We did that, typically structured as a 30-year amortization, Ryan Beckett. How is the treated by seller from a tax standpoint? We talked about that. Oh my gosh, you guys had a lot of questions. We got the servicing company. Have a transaction that matches all the elements. I'll call you Jim to prepare a plan, Federico. So Federico, I got a call this morning from somebody on a seller financing deal for an equestrian community. And that seems to be a real popular tool. An agent called me. I thought it actually wasn't the seller, it was an agent, but they said that they're seeing, you know, these are the equestrian properties seem to be seller finance realistic options.
Is that in Davie?
Actually, I didn't have time to get into it with the agent. I didn't find out where the property was located. They just said, give me a call after the Zoom. I think they're on the meeting also. Could it also make sense if the seller's going to foreclosure and would affect your credit? So a lot of subject to sales. Somebody's got their mic on.
And Patrick,
Let's see.
there you go. Thanks, Patrick.
A lot of subject to sales are where you have a distressed seller. And so if the property's in foreclosure, now the borrower has to pay a lump of money to reinstate the loan. So there's a burden on a buyer if the property's in foreclosure, because the loan needs to be reinstated to be brought current so that it can be paid upon. And that's just another hurdle that you have to overcome. Can it make sense? Yeah, the subject to makes sense. The subject to in foreclosure can make real sense. You just run into the practical problems of relying on the borrower to make the seller's loan payments. Again, a wrap, in my opinion, is the answer to that dilemma. Anybody have any other questions? I think we covered everything in the chat.
No, this is good, Jim.
All right.
Awesome.
So
I just want to add, Jim, that I remember this class made me remember the certification classes where I learned this concept, but this concept now from today on, they mean that we can do more businesses. They're very practical. They're tools that we can use. I just realized I have a buyer that exactly matches what you described. So the seller financing could be a possibility, not to have the break. Yeah, you say the day. You say the.
It is.
Federico, you just made my day, right? So my whole goal is I get calls from realtors all week long, texts from realtors, and I come up with the topics based on what you guys tell me. So the reason we did creative finance is because I've received so many creative finance questions. I encourage you guys to call me, text me 24/7. Texting is the best because then I can call you back. But this is the way it's supposed to work, right? In the ideal world, I say it and I'll say it again, iron sharpens iron. You guys come up with the topics. I want to get you in and out of deals quicker. We invented a bunch of tools like Title Advance, Title Leap. Title Leap keeps everybody in the know 24/7. Title Advance gives you the ability to examine title before you get the listing, and then you can walk into the listing appointment looking super sharp. We just had another deal Title Advance could have pulled out of the hopper with a seasoned agent that's used Title Advances in the past, and they didn't use one on this deal, and now the closing is going to get delayed. All the stuff we do is to keep you guys efficient. So I appreciate that, Federico. It's nice to know that this stuff pays off.
I want to add one thing really quickly. Federico, I know we've worked together before, and just most agents in here, you've worked together. If you guys have questions and you can't even reach Jim, the whole team's available. You have our email, you have the office line. Any question you guys have, we're all available to help you out. And even if we don't have the answer, we can get the answer and get back to you in a timely manner.
Absolutely. Thanks, Taj. All right, Ryan, did you want to close with some real trade?
No, it was
props?
great. I was just going to give a plug for you, Jim. You know, this title advance guy saves you. Like if I've used it a couple times now, some things that came up that you cleared up prior to like going under contract that who knows could have drug out the deal. And also I can't say enough thing about, you know, title leave. It's almost like a contract coordinator that I use on my own personal deals. Remember, I'm out there hustling just like you guys, even though I have real trade, but it's a great tool and it's saved me. It's, you know, and it's free. It's a free service for agent. Another thing too, guys, Real Trade's free for you. Get on there. I'm telling you, take the 10 minutes, create a profile if you haven't yet, and 10 minutes for 50 grand. No joke. There's agents on there that have made 50 grand from just making a nice profile. So
And the other thing about title advances, right? We talk about how it can save a deal or prevent stuff that was going to be a speed bump on the road to closing. But if you have a deal that's squeaky clean from a title advance perspective, you can always throw that option on your seller that we can close this thing quicker because we don't have issues, right? And so if you have clean title, you can get that thing to the table quicker. Go ahead, Bob.
I just want to talk a little bit about title advance. Super important. I remember I was doing a transaction. Jim was doing a transaction with a property. He was talking to me about title advance. Hey, Paulo, you always want to do title advance, and you're listing that guy. So I got this listing. I believe I know if that was 400,000, something like that. And talked to the seller. The seller said, "No, I don't have any problems. I only had this loan. I only had this loan in the property. It's King and Club." James telling me, "Pablo, do the title advance because you want to spin your wheels. You never know with the sellers. They don't know much about it." I said, "No, James, I just checked the mortgage. She was about to get foreclosure, but she only owned like 20,000 and she had a ton of equity." Let's say James said, "Oh, let's do it." So James do a title advance. It come out that the lady have some problem with the city and she owned almost the same of the value of the property. She was owning in fees, I believe was like $350,000 or $400,000 because they were closed. The property was on a properly closed. Remember, the title has some issues. And what James come up was able to sell the deal by negotiating the liens with the properties. We were able to close. But to be honest, you never know, and you always want to check. And it's an amazing tool, the title advance, you know. And I don't believe any other title company has it, or I haven't seen it, you know, or advertised. It's super helpful. We'll be able to close the property. But if I would have done the title advance before the listing appointment, I would know what I was facing, and I was able to tell the seller, this is what we have to do, follow up. So I definitely encourage anybody to do it. Even if you think it's like the cleanest deal ever, always do a title advance. It can save you time. I will save you a ton of money. You know.
So we did one the other day. Thanks, Pablo. We did one the other day. Realtor was going to meet with somebody in Port St. Lucie. The seller had owned the property forever. I encouraged them to get a title advance, and I had an MB Realty perpetual listing lien. So they showed up, they had the quick discussion with the seller. Seller said, "Hell no, I'm not paying two listing commissions, two realtor commissions on the sell side." And the realtor didn't waste any time. They got out of there quick. So the title advance saved them a bunch of time because they would have gone to closing and the seller would have been screaming that they're not paying two listing fees. Now they would have had to take in a reduced fee to make the thing close. When I've seen, Ryan, you've seen that happen.
I had that happen to me, guys.
Yeah.
No joke. This MB Realty thing, and we touched on that at another, topic that we had, but the title advance will save you for that. Headaches, ends up doing a bunch of work, having to cut the commission at the end to make the deal work. And it was just not hardly worth my time. So cool.
All right, you guys.
It's been a good one, Jim.
That wraps up another session. We're an hour and 7 minutes into it. There was a lot there we unpacked. If anybody has any questions, call me, text me, and let me know what you want to hear about in the future. We were thinking about service animals. We were thinking about contract tips. We were thinking about all kinds of stuff. So anything you want to know about, let me know. All right.
Awesome. Thanks, Jim.
Be good.
All right, bye.